Hey there, welcome back to the podcast. I'm so glad you're here. Today, we're going to walk into what I like to call the investment arcade. No, it's not a real arcade with flashing lights and pinball machines, but stick with me, because this is way more important. We're talking about the world of investment options inside a 401k plan, and trust me, understanding this can make a big difference in your future. Whether you're 25 or 55, this is one of those things that can seem complicated at first, but it doesn't have to be. So, let's make it fun, let's make it simple, and most of all, let's make it stick. Picture yourself standing in front of a giant arcade machine, but this isn't for entertainment, this one's for your retirement, and every token you put in, that's your 401k contribution, your hard-earned money. Now the real question is, what kind of games are inside this machine? What investment options do you have? Let's take a walk through this arcade together. Before anything else, you need to be part of the plan, your employer's 401k. Once you're in, you don't just sit back. You get to choose where your money goes. Now, most 401k plans don't let you pick individual stocks or bonds, unless they offer something called a self-directed brokerage window, which I'll explain in a bit. Usually you're choosing from a menu of investment funds. And yes, this menu can feel overwhelming, but don't worry, let me break it down for you. Here's what you might see. Mutual funds, where your money is pooled with others and managed by pros bond funds, generally lower risk. Investing in debt like government or corporate bonds, target date funds, these automatically adjust as you get older. Money market funds, low risk but also low return U.S. Treasury securities, backed by the government company. Stock funds, you invest in your own employer asset allocation portfolios, built around risk level self-directed account windows. For people who want total control, individual securities, stocks and bonds, only through self-directed windows. Each of these options has a goal, each one has a level of risk. And here's the golden rule. Risk and reward go hand in hand. If you're aiming for bigger returns, you might have to accept more ups and downs. That's called risk. If you're saving for something far in the future, like retirement, you can afford to take more risk. But if you're saving for something short-term, you might want to play it safe. Let me introduce you to two terms you really need to know. Time horizon. This means, how long do I have before I need this money? If you're 25 and saving for retirement, your time horizon is probably 40 years. That gives you time to recover from market dips. Risk tolerance. How comfortable are you with seeing your account go up and down? Some people can handle a roller coaster, others prefer the kiddie ride. Either way, it's your ride, and you get to choose. Okay, here's a crowd favorite. Target date funds are perfect if you want something simple. Let's say you plan to retire around the year 2065. You might choose a target date 2065 fund. At first, it'll invest more in stocks because you're young and have time. But as the years go by, it shifts more into bonds, safer, steadier options. It's like a self-driving car for your retirement savings. As of 2025, nearly every 401k plan offers these funds. In fact, more than 60% of people put most of their money in them. Now maybe you don't care about the year you retire, you care more about how much risk you're willing to take. That's where asset allocation portfolios come in. You'll often see categories like conservative, moderate, aggressive. Pick the one that matches your comfort level, then pros manage it from there. Mutual funds are a lot like joining a team. Your money gets combined with others and a professional investment manager decides where it all goes. You might be in a fund focused on US companies or international ones, or tech companies only. Whatever it is, there's always a strategy behind the scenes, and your plan's website or the fund's prospectus will tell you exactly what you're investing in. Now this one's interesting. Some plans let you invest in your own company's stock. It sounds cool, you believe in where you work, why not buy in? Well, be careful. Having too much of your 401k in company stock can be risky. If the company hits a rough patch, so could your retirement savings. Diversification matters. As of now, around 27% of large employers offer this option, but they often put limits to protect employees. Bonds are like IOUs. You lend money to the government or a company, and they pay you back with interest. These funds are usually more stable than stocks, but that also means their growth is slower. Still, they're great for balance and for those with lower risk tolerance. If you're the kind of person who wants full control over every dollar, you might love the self-directed brokerage account. This lets you move some of your 401k funds to an outside brokerage and invest in individual stocks, ETFs, real estate funds, almost anything on the open market. But heads up, these accounts usually don't allow loans or early withdrawals until you move your money back into the main 401k, and only about 5% of people use this option. Here's a quick legal note. Under ERISA, that's the federal law governing retirement plans, employers are fiduciaries. They must act in your best interest. But if they offer you at least 3 diverse investment choices, like one aggressive, one moderate, and one conservative, they're not responsible if your picks don't work out. So, the freedom is yours, but so is the responsibility. Here's what I want you to remember today. You don't need to be an expert to make good investment choices. Know your time horizon and risk tolerance. Use target date funds if you want a simple, smart option. Explore asset allocation if you prefer to pick your risk level. Be cautious with company stock. Don't put all your eggs in one basket. And if you want total control, a self-directed account might be for you. You don't have to do it all at once. Take your time, learn as you go, and most importantly, don't leave your money sitting in cash. Put it to work for your future self.